What is happening, people? It is your boy Jack. I'm not a financial advisor, and today I'm going to be speaking about my top 10 stocks that I'm going to be keeping a close eye on next week. And next week in particular, I have my eye on a whole lot of growth stocks, so if they are of interest to you, you are going to enjoy this video. I think everybody likes a good growth stock. I mean, the potential to make hundreds of percent on your money in a matter of years, that's always really exciting, no matter who you are. I want to say quickly, I'm making these videos pretty much every week, top 10 stocks to watch next week. And I'm not sure if I'm overdoing it because the support is always insane, but I don't want to force these videos out. So I'm thinking about changing it to every 2 or 3 weeks. If you want them to stay weekly, please just show some massive support on this video. Just drop the like and drop me a comment, let me know that you enjoy these videos, and then I will keep it up weekly. But man, it is a beautiful day here in Ireland. The sun is shining, I'm in a fantastic mood, and I want to talk to you guys about some stocks. So please do smash that like button, drop me a comment, and subscribe if you are indeed new around here. All of those things genuinely help me out so much. We're so close to 5,000 subs, and there's so many of you guys who still aren't subscribed to watch the videos. Help me out, man. At 5,000 subs, my full stock portfolio is getting revealed, and I'm gonna very soon have these hoodies available for you to buy, so please help me out. With that being said though, we have 10 stocks that we have to go through today. 10 exciting, juicy stocks that we have to go through today, so we're gonna get straight into it. Keep in mind that in these videos, I keep the analysis very short, or else the video will be about 406 days long, and nobody wants to watch a video that's 406 days long. With all of that being said, guys, let's get straight into the first pick of today. I'm buzzing today, man. I'm in a good mood. So the very first company of today is a company I've never spoken about on the channel. It is a company called Revolve Group. Basically, what Revolve do is they just sell very expensive clothes. So you can imagine that right now, in a time where people don't have a lot of money, people have had to cut their expenses. They're not going to be spending €118 on a pair of jeans. But in recent years, we have seen many of these, high-end fashion retailers make an awful lot of money. And what Revolve do really well is their advertising. They do so much of their advertising through social media, through really popular female and male social media stars. And this will be a bit of a theme that we go through in a good few companies today. I believe a lot of the world is moving online, and I believe there's a lot of space for companies like Revolve to, make a lot of noise. So these guys only went IPO back in the 7th of June 2019, so not even a year ago. And we've kind of seen what we've seen happen with a lot of companies when they go IPO, They start off nice high price, and then they slowly decline down, and we can see that from their launch, they're down close to 60%. Now, in the last 6 months, this is where things get quite interesting, okay? From the highs down to the lows, they fell about 65%. As of right now, they're still down 33% from the highs. But that recovery has been fantastic. From the lows up to the highs, nearly 100% gain in the space of, a couple of months. And if we just have a look here, the 7th of May to the 8th of May, they had this day where they went up 25% in a single day. So a few points, right? Management noted that sales grew 20% year over year in the first 2 months of 2020. So there was some fantastic growth before this whole situation started to happen, okay? And then, before falling away in March. Furthermore, its high-end products may not be in demand if we head into a global recession, so the next couple of quarters could be bad. And this is very true, and a lot of what's to come with Revolve will depend on, how fast economies start opening back up, when people get back to work, when people get back to making an awful lot of money to afford their clothes. Because let's be honest, they're very expensive, and people aren't going to buy those expensive designer clothes if they don't have much money. They're going to go to a cheaper retailer. Active customers grew 27% from 2018 to 2019. So when things are going good, this company was doing very good, and they're very new to being an IPO. So as far as growth stocks go, to me, these guys look fantastic, okay? And I actually think that this is a price I will be relatively happy to get in at. With that being said, I don't think the red days are over, so I'm not in a particular rush to get into these guys. But when I see an opportunity, if I see a 10, 15, 20% drop over the space of a day or two, I'm going to be quite inclined to get into these guys. But even at $14 a share, I think it's a very fair price. So it definitely isn't one of those really safe investments, but it is an exciting one. It is a growth stock in my eyes. You're not buying these for their 0% dividend yield. You're not buying these because you think you might make 10 to 15% per year relatively safely. You're buying these because you believe that when times get better again, which inevitably they will, or else the world is just going to end, that their price will go up and up. You're also betting that they obviously don't go bankrupt, but I don't see that happening. And we have a look at the balance sheet, okay, and they're a relatively small company, but their current assets are at 227 million, okay? Total assets 259 million, and their total current liabilities and total liabilities are only at 123 million. So they have no long-term debt whatsoever. They have much more than enough cash on hand to deal with the debt that they have. these guys most certainly are still getting orders, so be it not as much, but they are still getting orders. I think they should relatively easily be able to get out on the other side of this quite well. And I know for a fact that they're still paying a lot of money for advertising. Now, I don't know how much, but I've seen them on several social medias. I've seen big influencers promoting their stock. So these guys obviously aren't in the worst position in the world. So with that being said, at $14 a share, which is still down 33% from their highs, I think these guys offer an awful lot of growth potential. And I may well pick them up as, you know, a spec / growth stock. I don't see the risk to reward being absolutely crazy here. I don't think there is too much risk. But they're definitely an interesting company, definitely one that I want on my watch list, and definitely one that I do plan on picking up soon. And again, it's only $14 a share, so you'll be able to get a decent position in these guys, and who knows what could happen in the future. So we're keeping it short and sweet. That's company number 1 now. On to company number 2. We're having a look at Spotify, okay? A company I actually made a full video on very recently. So if you want to check that video out for a deeper analysis, have a look at that. But Spotify, okay, a company from 6 months, they haven't fallen from their 6-month highs. In fact, they've making very big new highs. They're currently trading at $180 a share. They were up as high as $192 a share. Now again, another company who's relatively new on the stock market, okay, the 6th of April 2018. And again, like we see with a lot of IPOs, we have this initial drive to the upside and then a big sell-off. And this is something that's very common to see. But this last while, they've made a fantastic recovery, okay? So again, this is a stock that I want to buy. I really do want to buy them, but I don't want to buy them at $180 a share, okay? I'd be quite happy to buy them anywhere below $150. Now, who knows if that's going to happen or not? They're doing so well right now, and they're making big moves. It may well not happen. And if it doesn't happen, and I miss out, so be it. But if they fall below $150 a share, I more than likely will pick up a share or two. So the biggest piece of news in regard to these guys recently is that Spotify went ahead and signed the Joe Rogan Experience to an exclusive multi-year deal. So this is massive, because obviously Joe Rogan is massive. One of the biggest podcasts in the world. And forever, he's just uploaded those podcasts to his own YouTube channel. And now he's gone exclusively to Spotify. You just have a look at the views that this man pulls in and how often he uploads his podcast. He's extremely consistent and he's bringing in millions of views every single day. He has millions and millions and millions of very loyal listeners who more than likely would be willing to pay for Spotify Premium just to listen to him. So this is definitely going to be a great thing for Spotify. And again, the thing is with Spotify, I see them as being a growth stock. I could see these guys being worth a whole lot more than they're worth now. I might be a little bit greedy not buying them at this price point, but I would just feel a lot more comfortable buying them if I do see a second little dip. You know, 15 to 20%, I'd be very happy to buy into these guys. But again, I will leave them there because I have that full video on them. But yeah, very exciting company, one I'll be keeping my eyes on very, very closely and hoping that I can get in at a nice price. If not, I miss out. These things happen. Okay, we're looking at another company who's actually performed very well because of the virus, who's actually gotten more business because of the situation we're in right now. We're looking at Shopify, okay? And again, it's a company that is so exciting, that I see so much potential for, that I really want to buy, but I don't want to buy at this price. From lows to highs, these guys are already up 135% in a space of a couple of months. It's clear to see why these guys are doing so well right now. There's a lot of people moving their businesses online. There's a lot of people making new online stores. When I'm selling these hoodies, it's going to be done through Shopify. You know, that's where I'm going. And a lot of people are doing this now because they've more free time. They've more time on their hands, you know, set up that business they've wanted to set up for a while. So I think it's an absolutely incredible service. I really do. But I also think that the price has been inflated heavily because of the situation we're in, because this is one of the few companies who's actually been able to take advantage of the situation we're in. So I would heavily expect a decent dip in these guys. And again, it's a company I'm not happy to buy at $757 a share. I'm just not. If you get these guys at the right price, I 100% think they're a growth stock. But what I also see happening is, you know, when economies start opening back up and most stocks, most companies are going to benefit, I think Shopify will do one of two things. I think its growth will either slow down massively and will somewhat trade sideways for a considerable period of time until they bring out something new, something that actually, you know, matters. Or else I think we're going to see a big sell-off as a lot of people don't have enough free time. They go back to work. They don't take care of their stores anymore. They don't pay the subscription. Right now as well, a lot of people who just signed up for Spotify, you get 90 days of a free store. That's what I have right now. A lot of people's stores will fail before those 3 months are up. So although Shopify may have an awful lot more stores right now, they may have a lot more customers, some of those may never give Shopify a single cent. So I do absolutely love the look of these guys, but again, not at this price. But the thing is, right, when you have a look at this balance sheet, it's going to be one of the best balance sheets you've ever seen in your life, okay? Current assets, 2.7 billion. Total assets, nearly 5 billion, let's say. Current liabilities, 288 million. Wow, incredible, okay? And total liabilities, 430 million. Absolutely incredible balance sheet, and that is part of the reason why I think their valuation is so high. But a good balance sheet can only bring a company so far, and a good balance sheet most certainly can lead to a company in the short term becoming overvalued, which is exactly what I think is happening right now. I'll be completely honest, in the long term, again, similar to Spotify, I don't think this is a particularly bad price by any means whatsoever. I just think there is going to be much better opportunities. Who knows if it's going to be in a month, in 2 months, in 3 months. I'm not in a rush to get into these guys, but I really do want to own them at some stage down the line. Okay, company number 4. Oh, we have Delta Airlines, baby. My favorite company, my biggest position. If you've watched the channel before, you know how I feel about these guys. You know I get very excited about these guys, okay? Delta Airlines. They've had a fantastic last little while, okay? We've seen some major rallies upwards, nearly 40%, okay, from the recent lows, very recent lows. In a matter of a couple of weeks, up 30 to 40%. The question is it justified? You know, why are they going up? Do they deserve to be going up? Is there going to be more downwards movement? I believe there most certainly will be more downwards movement, okay? Obviously there will be, but I do think the general trend we're going to start seeing very soon is up. The world is starting to open back up, guys. More flights are going to be added. There's going to be more planes. These companies are going to be making money again soon. They're getting sorted out by the government. They're actually in a much better position than they were 2 months ago. Countries are opening back up. As of July 1st, Spain is back open to tourists, okay? There's going to be more flights coming from places like Delta. Many countries will follow suit. Germany, Portugal, loads of European companies are beginning to open back up to tourists, which is ultimately going to mean a lot more money for these airlines, okay? They are doing absolutely brilliantly, and the prospects looking forward look amazing. I am so happy to own how much I do in these guys. In the last couple of weeks even, okay, the amount of passengers screened in US airports went from about 80,000 to over 200,000. So still a very insignificant number. But that growth is crazy. And if that growth continues to go, there is no way that airlines can go much lower. You know, they're going to have to start growing again. So these are a company, Delta, I love to absolute pieces. Right now, I'm up very slightly in them, so I can't really, you know, get my cost basis down too much unless I see some red days, but I'm ready to buy more of these guys at this price point. I am more than ready to spend $25 a share on some more shares in Delta. I bought a lot down here around $19 to $20. Initially, my cost basis with Delta was about $35, and I got it all the way down below $25. I bought the whole way down. I bought more aggressively the lower we got, and that is still my plan. I'm going to slowly add shares as of right now. If I see another big dip, I'm actually afraid of how much money I'm going to put into Delta. But anyway, I speak about these guys all the time. I will leave Delta there. Number 5, we have Facebook. Another company I have a full video on if you do indeed want to check it out. And is now my second biggest position in the portfolio. I absolutely love Facebook. I love the balance sheet. I love what they actually do. I love the risk to reward ratio. I just think it's an absolutely I think it's a no-brainer, guys. We head over to the max stock chart, which only goes back as far as 18th of May 2012. And as of right now, they've paid back, you know, about 500% return. In the last 6 months, they saw this dip, you know, they saw that 35% dip. I wish I had bought them here, but I didn't. It is what it is. And as of right now, they're actually pretty much back to their all-time highs, and they have gone past those all-time highs. So a lot of people might think they're overvalued. I think for a company like Facebook, they are not whatsoever. A PE ratio of 32.39. I know in general that seems a bit high, but it's Facebook. Another company with a beautiful balance sheet, okay? Current assets, 69.34 billion. Total assets, 138 billion. Current liabilities only at 15 billion and total liabilities at 33 billion. So I mean, absolutely fantastic balance sheet. These guys are going to do whatever they want. You know, if they see another company they want to pick up, they have more than enough cash on hand. They can go and buy that company, get all of the CEOs on their team. I'm not going to talk about these guys too much, but they also own Instagram, who they bought for 1 billion, who is now worth over 100 billion. And WhatsApp, okay? They bought them for 19 billion. WhatsApp currently has 1.5 billion users, and it's not monetized, okay? So that's just another stream where Facebook could make a whole lot more money. They could offer a premium service. They could run ads. They could do a lot of things and start making money. And as well, Facebook is getting more and more people, more and more monthly active users on their main website, Facebook, every single month. They have over 2.6 billion monthly active users right now. They run an awful lot of ads. Again, one way they can make a whole lot more money, up the cost of their ads by 1 or 2%. Most advertisers would barely even realise, would still be willing to pay the rates because they know how cheap it is in comparison to other places, and they'll make a whole lot more money. But again, I have a full video on Facebook. If you want the full 15-minute breakdown, check out that video. Okay, another company I haven't actually spoken about on the channel before, but a lot of people have asked me to do so. We're looking at Square. Now, we'll get into just what they do in a second, but from highs to lows, these guys dropped about 55%, and now they're currently back up to their highs. So what a recovery of over 100% in a matter of a couple of months. So what do these guys actually do? They provide payment and point of sale solutions in the United States and internationally. So again, earlier I said I see a lot of the world moving online, and I also see the world moving away from cash, okay? A lot more people are using their cards to pay. We're using Apple Pay to pay. We don't use cash nearly as much as we used to. I've said it before, but I don't really have cash right now. I literally go to my phone, I use my fingerprint, and I pay for anything I want just using tap. So to me, a company like Square has a whole lot of room to grow going into the future. And it's a company who I actually do think is at a decent price. I do think they're at a relatively fair price, you know. They're approaching all-time highs, but they're doing absolutely fantastically as of late. We'll just have a quick look at this. So they bet estimates, okay? They reported revenue of 1.4 billion that beat Wall Street's estimate of 1.3 billion. Their Cash App saw its revenue jump nearly 200%. These guys are absolutely smashing it. And it's another company who can potentially take advantage once the virus is over, you know? Once the virus is over, even more people are going to want to be using their cards and contactless payment as opposed to cash, because everybody, even when it's eradicated off the face of the earth, people aren't going to want germs. They're going to be more germ conscious. They're not going to want to carry cash that could have touched 500 people before them. And another company with quite a nice balance sheet. Okay, current assets nearly 4.4 billion, total assets 6 billion, current liabilities 2 billion, and total liabilities 4.2 billion. So a good balance sheet. They're going to be able to get through these tough times, you know. They more than be able to get through these tough times. They're going to come out of it on top, and I see that share price going up. Honestly, I don't really see much room for another big dip. So it's a company I think they're at a fair price. They have that growth stock potential. Now I could see these guys booming up over the space of 3 to 5 years, way more than 100%, far more than 100%, depending on where the business goes. Again, there's always risk associated with every stock, and I'm not a financial advisor. These guys definitely could go down in value. Anybody could. But I just think the risk to reward ratio is very, very good. So that's where I'll leave Square. Okay, Wells Fargo. This one may confuse a few of you, because recently in the videos I've been saying that I don't really plan on buying these bank related stocks until I start to see some good news. But I'm starting to see some good news. Wells Fargo as of right now is my worst performing company. I think I'm down like 20-something% in them. Not good whatsoever. I want the dollar cost average down, you know. While they're in the red, I'd like to get a better cost basis. Now, do I see more room for red? Most certainly I do. And I completely understand that investing now, you know what, I might get a better deal in a month or so time, maybe 2 months time. It could be a slow recovery. But I had to reevaluate things. I had to remember that I'm a long-term investor. It makes sense to invest when a company's been particularly beat up. Sometimes it's scary to invest in a company when you fully acknowledge the fact that they may well go down another 10-20% when they've already been absolutely hammered down over 50% and they're still down pretty much 50%. As a long-term investor, sometimes that's okay. Sometimes you still have to go ahead and invest some more. Now, I definitely don't expect everybody to agree with this. I definitely don't think that a lot of people will even think that Wells Fargo are the best bank stock out there when you have the likes of JP Morgan and US Bank Corp, even those kind of companies. I know Wells Fargo have a history. They have a poor history, you know. There's been a lot of drama in relation to these guys. But at the end of the day, I think investing in a company like Wells Fargo is investing in the long-term success of America. I'm never going to let these bank stocks take up the biggest position ever in my portfolio, but I do think and I do believe that they're a sector that I want to own. So again, I want to make it really clear, I don't expect even the majority of people, I don't even expect many people at all to agree with me on this one. This is very specific to me and my portfolio and where I bought them the first time. But to me, I think I'm going to be picking some more of these up over the next couple of weeks. Maybe not next week, maybe not even the week after, but I want to pick up a substantial amount of them relatively soon. It's all well and good buying a company, you know, when they've gone up a bit and they've room to go up more. You know, it's exciting. You might think in the short term it's low risk, but we have to think about the long term. And what I'm looking at is a company who is trading at $26, you know, who has traded up. We've traded up at $60-ish plenty of times. Even in the last 5 years, you know, we've touched into that $65 mark. They also do have that dividend yield of 7.71%. Now, who knows if that dividend is safe? It's really hard to know. They only have a dividend growth streak of 9 years. So anything could happen. So I wouldn't buy them just for the dividend. I think there's far better, safer options out there if you're going into a company just for the dividend. But a company who has that 7.7% dividend, who I see has a lot of room to move to the upside, maybe it is relatively high risk, I will give you that. I still think it's safer than a spec stock, and I still think it could have massive growth in the years to come. So I won't get too into them. Again, I probably will have to make a full video on bank stocks in general, just because I get a lot of questions about them. But Wells Fargo is on the list. So next up, we're having a look at Netflix. I've only ever very briefly touched off these guys in the past, okay? And as of right now, they're the only company in FANG that I don't own. I own Facebook, I own Amazon, I own Apple, I own Google or Alphabet, and I don't own Netflix. So again, for me, Netflix is more of a company to watch. It's more of a company that I want to see take a dip before I buy them, okay? I'm not happy buying them at this price of $420-ish when they're up 40% from the recent lows. And a lot of that will be heavily down to the fact that there's more people stuck indoors. There's going to be more people buying Netflix. I know this for a fact because my dad bought Netflix for the home. We've never had Netflix before. A lot of people are spending more times indoors. They're spending more times watching TV, films, whatever it is. So a lot more people are going to be buying Netflix. And when a lot of people get busy again, I'm sure a lot of them are going to cancel those memberships. Now, a lot of them will keep them on. And what's happened now inevitably will be good for Netflix in the long term. And I do think that they're an absolutely fantastic long-term company. I just think that the price is somewhat inflated. Now, the main argument I have for myself, okay, is that even though the price is inflated, I do see it as moving upwards before it moves down, okay? I see this potentially having a very good month, 2 months, 3 months. And then when people start to cancel their memberships, it might have some sort of a pullback. But do I think it's going to fall below this price? That is very difficult to say. It's not like there's any previous history to go off. It is complete and utter speculation. And that's why they're the only FANG stock I'm not in yet, because I'm just not 100% confident in what I believe the short and long term for Netflix is, because again, there's so much competition as well. And we have a look at the balance sheet, and it's good, but it's not quite your standard FANG balance sheet, okay? Current assets, 6.44 billion. Total assets, 35 billion. Current liabilities, 7.8 billion. That's more than their current assets. Now, of course, they're going to be okay, but still, that's weird to see for a FANG stock. And then total liabilities, 26.6 billion. So by no means a bad balance sheet. It is a fine balance sheet. But it's not the likes of a Facebook or a Google or anything along those lines. It's trading at a PE ratio of nearly 85, okay? I don't think this is a good price. Again, I could well see it going to $500-600, whatever it is, in literally a matter of months. It could well happen. But just as easily, I could see it trading sideways. Just as easily, I could see it falling back towards, $350, even $300. It's very hard to know what's going to happen. I do just think there's some sort of inflation in there right now. So to make things clear, it's a company that I absolutely love the look of, okay? But it's very similar to Shopify and to Spotify in that I just think it's a little bit overvalued. So a stock to watch for me, not one I'm more than likely going to pick up. I do want to get them though, just at the right price. So a company I actually covered in a recent video, the top 5 growth stocks, is Visa. And I must say, I quite like the look of them at this price. We have a look at the 5-year stock chart, and they're up 185%. We have a look at the max stock chart. We go all the way back to 2008, and they're up over 1100%. So it's a company who's done absolutely fantastically. And as I've said a couple of times in this video, I see a lot of the world moving online. I see cash dying off, so I see companies like Visa doing well. I'm looking at a company who won't have been hit particularly hard because of the pandemic. I'm looking at a company who still isn't back up to their highs. I'm looking at a company who to me is very attractive, who I could definitely see paying me back hundreds and hundreds of percents in the years to come. And now we have a look at the balance sheet, and I'm looking at a company who has total current assets of nearly 20 billion, okay? Total assets 72.8 billion. Current liabilities nearly 16 billion, so decent position to be in, and total liabilities of 38 billion. So from a long-term point of view, they're looking fantastic. From a short-term point of view, they're absolutely fine as well. So there's no risk of bankruptcy or anything along those lines. So the question just becomes, is this a service that we're going to need in the future? Is there room for growth? And I think the answer is most certainly yes. I won't get too in-depth because, as I said, I spoke about them recently on the channel. Again, I'll leave the video on the screen or something like that if you do want to go have a look at that video. But a company I absolutely love the look of, and a company who I actually think is at a decent value as of right now. Again, we look at a PE ratio of 35, which traditionally is quite high. but it's a company who has an awful lot of potential going forward. Okay, the final stock of today. We're looking at a little company called Aurora Cannabis, okay? Now, if you're up to date with what's happened, you will know that very recently, over the space of literally a week, these guys boomed up nearly 200%, okay? Now, since that high, they've started coming back down a little bit. Where are we? From that high to where we are right now, down about 20%. So I'm still kicking myself because I was about to buy a considerable position in these guys around the $8.5, $9 area. I had the app open on my phone, I was about to click the buy button and I said, nah, I won't do it yet. And then this happened literally a couple of days later and I was absolutely sickened with myself. So, for me, a stock to watch. In all honesty, I think from a long-term point of view, this price is very fair. But also, I think it's going to go down further. Again, maybe I'm being greedy. Maybe I should just pick them up at this price. And maybe I will pick a few up at this price. But I just think that the fact that we saw that kind of price action, a company go up nearly 200%. If you know me, if you follow the channel, you know that I don't really like to buy companies when I see something like that happen. So, what I'm hoping for is a little bit more of a pullback. Again, even at $19 now, I think it's a fair price. I do think it's a good price. And I might be being a little bit greedy. But I just think they've so much potential going forward. They're in this emerging market. They're in this growing market. They're one of the leaders. They're smashing it. And one thing about these guys is they just recently completed their acquisition of Revolve LLC. These guys are a leader in the sale of hemp-derived CBD products in the US, okay? So right now, Aurora Cannabis is in Canada, okay? And now they're trying to penetrate the US market. That's going to give them a whole lot more customers. And as we all know, cannabis is starting to get legalized in more and more places in America, and more than likely, it's only a matter of time before it's legal all over America. And if that's to happen, I see a world 100% where we can see prices like this, $140, $150 and beyond. If these guys can be one of the big players in this emerging market, it's going to be crazy, okay? So again, company like this, you know, there is a decent bit of risk, you know, there's definitely a possibility where they drop back down to this price point, or even lower. There definitely is a possibility, but I think that their outlooks, their fundamentals, everything looks quite good to me. You know, it's quite exciting to me. And again, quite a nice balance sheet. Current assets, $465 million. Total assets, $3.35 billion. Current liabilities only at $146 million. And total liabilities only at $582 million. So they have the means to go about and, you know, do these acquisitions. They could do this again. They could find another company they want. They could make a bigger market share for themselves and just increase their potential. So the fact that they started dipping even after this news of acquisitions and those things have started to come out, I think it could go lower. We're seeing this thing where we see unhealthy price action, we see massive moves to the upside, and now there's going to be some sort of a correction. We know a lot of people will take their profits and sell off, and then hopefully I'll get to buy in somewhere around here. Who knows, maybe we'll get to $14, $15, $16. But that is it, guys. That is 10 companies that I am hopefully going to either buy or they will be what next week. If you are one of the people who watched till the end, I genuinely appreciate you so much. And I would appreciate it massively if you would hit the video a like and drop me a comment. Just honestly, I want to know if people want to keep seeing these videos, because they do well. I just don't want to overdo them, and I would just appreciate it massively if you could do those two things for me. These are some of my favorite videos to make, I will admit. I love just speaking briefly on loads of different companies, and people do seem to enjoy them, but again, I don't want to spam them out. I hope you guys did enjoy though, and I hope you guys enjoy this absolutely beautiful weekend we're having. I hope the weather's like this worldwide. I will catch you all for tomorrow's video. Have a great day. Peace.